Hello, and welcome to our 2022 market preview video. On this video, you will hear from each of our lead asset class analysts as they take you through the risks and opportunities as well as themes to watch for each of their asset classes over the next 12 months. There will also be a quick review of what happened in 2021. It is our goal that this will help you and your committees plan for the coming year and appropriate decisions for your portfolios. In terms of agenda, we will start with an overview of what happened in 2021, as well as the broad themes to watch for in 2022. We will then transition and start with talking about the U.S. economy, since that's the natural backdrop to all the asset classes that will be covered. The traditional asset classes will be fixed income, U.S. equities, and non-U.S. equities. We will then move to the alternative asset class discussion, consisting of hedge funds, real estate and infrastructure, private equity, and private credit. Looking back on 2021, commodities were the runaway winner in terms of performance, followed by equities. And this continued the theme that we saw in 2020 of risk assets, predominantly equities, leading the charge. Of course, commodities were a vast reversal of what happened in 2021, and some would argue this was long overdue given middling performance over the better part of the last decade. Of course, the question is, who will the winner be in 2022, and which asset classes can be expected to outperform, and which ones will lag? It is our hope that the following comments of our analysts will help answer this question. Broadly speaking, what can we expect out of markets in 2022? What are some of the macroeconomic trends and signals that we will be watching for? The first, perhaps not surprising in any way, is inflation. Inflation has dominated the headlines in terms of market risks and market worries, and inflation will continue to be elevated through the better part of 2022. We do expect it to peak in the first quarter of 2022, but it will remain above trend all year. Interest rates will rise. The Fed has started its taper and is also committed to rate hikes in 2022 in an effort to combat inflation. We think supply chain pressures should ease, but labor shortages are still a concern, and these labor shortages are driving wages higher, which is a higher cost of production for companies and also a contributor to higher inflation. Opportunities in fixed income are limited. Rates are low and rates are expected to rise. These are two headwinds for the asset class, which will be discussed in more detail in that section. For equities, we think volatility will rise. We think volatility will rise because of the following aforementioned factors of inflation, higher interest rates, geopolitical pressures, and supply chain pressures. Earnings growth should also slow. The good news is that earnings growth will still remain positive. Overall, we think equity returns will be lower than what they've been over the last 3 years. And the reflation trade, which we saw during the first quarter of last year, in which value stocks outperformed, is also expected to continue into 2022. Last but certainly not least, we'll have a hearty discussion on alternatives. And one of the takeaways is that alternatives can help mitigate inflation, particularly real assets such as real estate and infrastructure.
Hi, I'm Tanner Maupin, Research Associate here at Marquette, and today I'll be covering the U.S. economy. 2021 was an interesting year. We saw supply chains break, inflation reach 7%, workers gain the upper hand on wages amidst an extremely tight labor market, and a robust recovery in the economy from pandemic lows. Many of these themes will continue into 2022. Inflation will remain elevated, but the supply chain pressures that drove inflation last year should ease. The labor gap in the United States is creating an extremely competitive jobs market, pushing wages higher. The Fed will complete its taper by March, and we will see the first rate hike in the first quarter of 2022. And lastly, we expect to see consumer spending rise this year from pent-up demand and savings from stimulus money. Inflation hit a 39-year high in 2021 of 7%, caused by labor shortages, bursts of consumer spending after lockdowns, and ongoing supply chain bottlenecks and constraints. These factors will likely lead to elevated inflation in the short term, but it should return to its historic average by the end of 2023. Supply chain constraints have been a major contributor to rising costs and inflation. Increasing demand for goods, slower delivery times, and shipping container shortages have all contributed to the supply chain backlogs we experienced in 2021. But sub-indices from the ISM Manufacturing Index could indicate a peak for inflation. While supply chain bottlenecks may persist into 2022, these issues should ease and improve upon last year's numbers. As shown in the chart below, new orders, supplier deliveries, manufacturing PMI, and prices paid seem to have peaked and have begun to decline. There continues to be many complications in the labor market. Health concerns regarding COVID-19, opposition to vaccine requirements, early retirements during the pandemic, mismatches in compensation expectations, and a myriad of other factors have led millions of people to quit their jobs. Even as hiring accelerated towards the end of the year, there is still a gap of nearly 4 million jobs. This gap will likely persist into the year. The unemployment rate in the United States is hovering around 4%, very close to full employment. But with the ongoing labor shortage, employment and recruitment are increasingly difficult, putting upward pressure on wages. This upward pressure has driven up input costs for companies and has ultimately driven up prices for consumers. With an aging population and ongoing concerns over the pandemic, we will likely see labor shortages and a tight labor market persist into 2022. As maximum employment is reached in the United States, the Fed has begun to accelerate its tapering. They will reduce their asset purchases by $30 billion per month, ending the monetary stimulus by March of 2022. Rates will likely be driven higher with the removal of stimulus, and coupled with the 3 rate hikes expected throughout the year, this presents a significant variable for economic growth and will likely lead to volatility in the capital markets. Although wages have decreased on an inflation-adjusted basis, we expect consumer spending to increase in 2022. Job growth, wage gains, and saved stimulus money, combined with increased real disposable income and historically low debt payments, indicates consumers are well positioned to increase their spending throughout the year. After the Fed's December meeting, GDP and unemployment projections improved for 2022, but inflation projections pushed higher. Although GDP numbers for 2021 came in lower than expected, the Fed has projected it will increase to 4% in 2022, ahead of its September projection of 3.8%. Unemployment for 2021 was far better than anticipated, ending the year with 4.3% unemployment rather than 4.8%. Projections for 2022 also improved, and unemployment is now expected to be 3.5%. Lastly, core PCE ended the year at 4.4% rather than 3.7%, and is expected to be 2.7% in 2022 rather than 2.3%.
Hi there again. This is Greg Leonberger, our Director of Research, and I will be covering the fixed income outlook for this year's video. Looking back on fixed income, there are 2 dynamics which drove markets. Number 1, interest rates on the whole rose during 2021. The 10-year Treasury started 2021 at 93 basis points and ended the year at 1.52%, which has driven price declines for most strategies in fixed income, simply because prices are inversely related to yields. The other dynamic for fixed income was tighter spreads. This is not surprising. When we see equity markets rally, credit spreads, which are a measure of risk for bonds, tend to go down. That helps bond prices, but also limits opportunities going forward. We expect both of these themes to continue into 2022. As mentioned on the previous page, interest rates rose, credit spreads tightened during 2021. For most bond strategies which feature heavy allocation to treasuries, this resulted in price losses for 2021. There were select indices which did rise during 2021, such as TIPS, in reaction to growing expectations for inflation, as well as high yield and leveraged loan, below investment grade strategies, which benefited from higher equity returns, which tightened credit spreads and drove returns higher. As we look out into the future, the expectation is that interest rates will rise, particularly on the short end of the curve, as the Fed bumps up the Fed funds rate in an effort to slow inflation. On the whole, according to this chart here, the 10-year Treasury is expected to rise from 1.52% at the end of the year to 2.04% in 5 years. And given the amount of movement we have already seen in the 10-year Treasury this year, that ultimate destination in 5 years may be higher than 2.04%. This is a pattern which bears watching over this year as well as future years. As we look across the different sectors in the fixed income market, there's not a lot of upside potential. As mentioned before, rates are low, credit spreads are tight. There's not a lot of upside potential. However, if we had to point to a couple of strategies which we think are the most attractive, we would identify those as bank loans and emerging market debt. We think bank loans are attractive because their principal resets as interest rates rise. So as rates rise, there's less price headwinds for bank loans. And we think higher rates will certainly transpire this year, and bank loan principals do adjust, mitigating those price losses. In terms of emerging market debt, spreads are wider today, so there's more runway for credit spread tightening and price escalation. However, we should mention that on an absolute basis, both spreads for bank loans and emerging market debt are still tight relative to historical averages, but relative to other fixed income sectors, these appear to be the most attractive. Credit markets are a fantastic indicator of potential stress in the market and signs of a coming market correction. On this chart here, we look at a number of different metrics for high yield and bank loans, which we can use to gauge the overall health of credit markets. And while not going through each one of these individually, intuitively, anything in green means healthy, anything in red is a sign of worry or potential concern. The good news is if we look at the 2021 column all the way on the right-hand side, it's almost all green, which reflects that credit markets are healthy, and according to credit markets, there is no bubbling source of volatility present in the markets. Therefore, this should translate into positive returns in credit markets as well as equity markets. As we sit here today at the beginning of 2022, how do we feel about fixed income as an asset class? The overall credit markets are healthy, reflected by tight spreads. Interest rates are still low and set to rise. Tight spreads and low rates with expected interest rate increases will likely translate into headwinds for returns for most fixed income strategies. However, fixed income is not just a source of return for investment portfolios, but also a source of liquidity and diversification, particularly in the event of market volatility or market correction. Therefore, we encourage our clients to remain invested in fixed income, but modify their expectations accordingly, given the fact that rates will rise and credit spreads are tight.
I'm Colleen Flannery, and I will be reviewing the U.S. equities section of this presentation. 2021 was an excellent year for the U.S. equity market and highlights once again the difficulty of predicting where equity markets will go. After a volatile 2020, markets continued to rally, with the S&P 500 index hitting a series of all-time closing highs and ending the year near record. In fact, the S&P's 2021 double-digit closure marks an annualized 3-year return of 26.1%, the highest annualized 3-year period since 2000. The fourth quarter brought with it a continuation of outperformance by large cap stocks, as the S&P 500 rose 11% during the period compared to a gain of 2.1% for the Russell 2000 index. Growth-oriented equities led the way up the market cap during the fourth quarter, while value-style stocks outperformed their peers in the mid and small cap spaces. While equity valuations remain elevated relative to historical levels, solid earnings growth has led to some multiple contraction in recent months, meaning that 2021 was the first year in the last few during which stock returns were not primarily driven by multiple expansion. Finally, while the fourth quarter saw occasional spikes in volatility due to, among other things, investor fears surrounding the Omicron variant, the VIX ended the year below its long-term average. For 2021, the S&P 500 and Russell 2000 indices posted returns of 28.7% and 14.8% respectively. Within the U.S. large-cap space, value-style equities began the year well in front of their growth-oriented counterparts. However, this trend reversed as the year progressed. The fourth quarter saw the Russell 1000 growth and value indices return 11.6% and 7.8% respectively, bringing the full year 2021 performance differential between the two benchmarks to just over 2 percentage points, with growth outperforming once again. However, this style performance differential was far more stark further down the market cap spectrum, particularly within small caps. But here, value outperformed growth by more than 25% for the year. Each S&P 500 sector notched a return in excess of 15% in 2021, as energy, real estate, and financials were the top performing segments of the market during the year. True to form, every sector was flat to positive during the fourth quarter as well, typical as market participants tend to close out the year on holiday-fueled animal spirits. Real estate and information technology stocks notched the strongest returns for the fourth quarter at 17.5% and 16.7% respectively, while the communication services sector ended the period flat. Despite a few spikes in market volatility throughout the course of 2021, most of which were related to the outbreak of new strains of the COVID-19 virus, including Delta and Omicron, the VIX ended the year below its long-term average. That said, many expect market turbulence to be prevalent in the coming year due to a variety of factors, including increasingly restrictive monetary policy, continued supply chain inefficiencies, and elevated valuations. Also of note, the S&P 500 exhibited a maximum drawdown of 5.1% during the year, meaning the index ended 2021 having gone roughly 18 months without a correction of 10% or greater. On average, the S&P 500 tends to experience at least a 13.5% drawdown when we look back over the last 30 years. So it wouldn't come as a surprise to see more downside volatility in 2022, assuming markets revert to the mean. It is worth noting that, as alluded to earlier, 2021 represented the first year since 2017 during which a positive S&P 500 return was primarily driven by earnings growth as opposed to multiple expansion. In fact, the multiple on the index contracted by more than 20%, representing the second largest drop in the multiple since 2010. Going forward, it is reasonable to expect that potential positive performance by most equity indices will continue to be driven by earnings growth, given where valuations currently sit, which we'll outline on the following slide. Despite the multiple contraction, U.S. large-cap equity indices continue to reflect multiples that sit at the extreme ends of historical levels. The same can be mostly said across the style spectrum for the mid-cap space as well. Interestingly, the small-cap value space, as represented by the Russell 2000 Value Index, continues to reflect relatively attractive price-to-earnings ratios, though other valuation metrics for the index like price-to-book and price-to-sales remain at extremes. While U.S. equities are expensive relative to history, they do remain attractive relative to fixed income securities due to the positive equity risk premium. This is the difference between the earnings yield on the S&P 500 and the 10-year Treasury yield exhibited in this chart. Domestic markets have now gone nearly 2 decades with a positive premium thanks to pervasive and historically low interest rates. That being said, future increases in rates may lead to a narrower premium in the coming year and may dim the prospects of equities vis-a-vis bonds. In conclusion, 2022 is sure to be an interesting year for domestic stocks. Potential tailwinds for performance of U.S. equities include the aforementioned positive equity risk premium, as well as the fact that both earnings and economic growth will likely remain positive the coming year. The fact that nascent and unprofitable technology companies, which enjoyed a meteoric rise in 2020, have struggled in recent time may also serve as a tailwind for performance of active equity strategies, many of which have distinct focuses on profitability and earnings quality. Still, stocks face several risks at present, including upcoming tightening by the Federal Reserve, which may hinder the prospects of high-duration growth assets. It is also important to remember the last several years have seen historic U.S. equity market returns, meaning future returns may fall short of those of recent time. Investors should brace for more volatile markets in the coming months while remaining disciplined and adhering to dedicated policy allocations.
Hi. My name is David Hernandez, and I will be covering the non-U.S. equity section. First, I'll spend some time recapping 2021 by discussing some of the major themes that occurred. From there, I'll outline some of our expectations for 2022 and how these expectations might impact non-U.S. equities. One of the big themes in 2021 was the dramatic underperformance by Chinese equities. After returning 30%, which was tops across the globe, China lost 22% in 2021. This was largely due to policy shifts and regulatory changes. Since China is about 32% of the benchmark, this had a large impact on EM equities, and as a result, developed markets significantly outperformed EM. Another knock-on effect was that the growth style within EM struggled, as many of the high-flying Chinese growth stocks sold off. The fact that we saw energy companies rebound throughout the world further pushed value ahead of growth in the EM universe. Finally, a major theme that came about was rising inflation as a result of supply chain challenges and a low interest rate environment. From a return standpoint, all major equity indices produced double-digit returns, with the exception of emerging market equities, which lost 2.5% in 2021. As I mentioned, China's sell-off heavily influenced this number, and there were actually several EM countries that returned more than 20%. India, Taiwan, Mexico, and Russia were all strong performers. So that is a review of 2021. The next set of charts, we will focus on 2022 and what investors might expect in this year ahead. Firstly, we think there are 4 key expectations to start this year. Most people who follow the markets know that inflation is higher and interest rates are expected to rise in 2022. It's very likely the Fed will have 4 to 5 rate hikes this year. Now, if you open up an economics textbook, you will read that higher inflation and higher interest rates likely mean a strong US dollar. While there are other factors that can influence the dollar, we think it's reasonable to say that over the first 3 to 12 months, conditions are set for a strong dollar. The 4th expectation is geopolitical grappling, and we think there are 3 relationships to watch in 2022. Now, we're going to talk about all of that in the upcoming slides, but first, let's start with inflation. Inflation has climbed throughout the globe. Here we show 3 developed regions and 3 emerging regions, and all have seen price increases. The price increases have been most significant in Russia, Brazil, and the United States, as well as the Eurozone. So what does rising inflation mean for equity returns? Well, I'm glad you asked. We looked at previous periods with rising inflation, and during almost all of these periods, equity returns were positive. So our takeaway on inflation is that inflation alone does not mean negative returns for equity investors. Now, my wonderful and outstanding colleagues on the U.S. equity side also produced the same chart, looked at the same data for U.S. equities, and their chart and data tell the same story. The second expectation is higher interest rates. As you likely know, we've been in a very low interest rate environment. In 2021, we actually started to see some emerging countries begin their rate hike cycle. Brazil increased rates by over 4% since 2019, and Russia by roughly 2%. When we update this chart at the end of 2022, we expect developed markets to join the group, with the Fed expected to deliver 4 to 5 rate hikes. So the question you're probably asking is, what do higher interest rates mean for non-U.S. equities? Well, again, that's a great question. If you go back to that economics textbook we used on the dollar movement, you might also read that higher interest rates tend to favor more economically sensitive companies and sectors. Financials, for example, often see their profit margins increase with rising rates. Historically, as the 10-year U.S. yield has moved up, it has generally meant better returns for financials. So what does this mean for non-U.S. equities? Well, we think this will serve as a tailwind for non-U.S. developed markets. The MSCI EAFE index, which is a benchmark for non-U.S. developed markets, has more exposure to financials and other cyclicals compared to both emerging markets and the S&P 500. The MSCI EAFE has 19% in financials compared to 11% for the S&P 500. So this is a potential positive for those that are on team non-U.S. developed markets. Next, let's talk about the U.S. dollar. With higher inflation and higher rates, we think it's reasonable to conclude that there will be a strong U.S. dollar to start 2022. What does that mean for non-U.S. equities? Well, the answer is both nothing as well as something, and it really just depends on what non-U.S. equities you're talking about. Here we're looking at the rolling 10-year correlation between a dollar index and the MSCI EAFE local index, which is the green line, and the EM local index, which is the baby blue line. We use the local indices to remove any currency effects so as to avoid any double counting of impact. Now, the key takeaway here is that the correlation or the relationship between the US dollar and the EAFE has moved around over time. It's not consistent. On the other hand, the correlation between the dollar and emerging markets has consistently been negative. This means that EM moves in the opposite direction of the dollar. Now, there are reasons for this. EM countries are typically more reliant on dollar debt, so if the dollar strengthens, borrowing cost goes up. Additionally, dollar strength results in fund flows that move away from emerging countries, which has a negative impact on those economies. So the bottom line here is that we think a strong dollar is a headwind for emerging markets, but really doesn't mean much for developed markets. So you can add another positive for those that are on team non-US developed equities. For those on Team Emerging Markets, I do have some positive news for you. Do y'all remember the taper tantrum from 2013? Well, if you don't, here's a quick reminder. This is when Fed Chairman at the time, Ben Bernanke, signaled that they would begin tapering its pace of bond purchases. And you saw a surge in U.S. yields, and as a result, emerging market assets sold off. There was a clever analyst at Morgan Stanley that created the term the Fragile Five. And this was a group of 5 emerging countries that were especially prone to currency and interest rate movements due to a negative current account balance. Well, 8 years later, through September 2021, which is the most recent data that we have available, we see that those Fragile Five are not quite as fragile. All of them have improved their fiscal positions. So emerging markets overall, we think, are better positioned to handle higher rates and a stronger US dollar than 8 years ago, but we do think that these will still serve as a headwind, especially over the next 3 to 9 months. Unfortunately for Team Emerging Markets, we do think there's another relative headwind for EM, and that is geopolitical risk. There are 3 key relationships we think are likely to have an impact on equity markets: US versus China, US and EU versus Russia, and China versus Taiwan. While we can't predict the outcome of any of these entanglements, we can say that any negative news is likely to hit emerging markets equities worse than developed markets. In particular, Chinese equities are likely to have the most volatility on any geopolitical hiccups. Speaking of China, one of the biggest questions for non-U.S. equity investors is how will Chinese equities perform in 2022? This country holds a large portion of the EM index at 32% and accounts for about 15% of the world's GDP, second only to the United States. Chinese equities returned 23% in 2019 and 29% in 2020, but drastically underperformed, losing 22% in 2021. We think investors likely need more time to adjust to the policy shifts by the Chinese government, which now has more of a focus on quality growth instead of all-out growth. But we think by the second half of the year, should things remain stable on the geopolitical front, Chinese equities are likely to show signs of a rebound. So when we think about opportunities for non-U.S. equities in 2022, we think a China bounce back certainly makes the list. We also think that developed markets should benefit from the higher rate environment. The MSCI EAFE index has more exposure to cyclical stocks and financials, and those typically benefit from higher rates. On the risk side, higher interest rates and a stronger US dollar serve as a headwind for emerging market equities. So we expect some road bumps in EM, particularly in the early part of 2022. Unfortunately, COVID-19 remains on the risk. This is a much longer risk than any of us would have foresaw in 2020, but it remains here for 2022. And finally, there are some geopolitical events we think are likely to have an impact on markets, so we will be keeping our eye on those in the year ahead.
My name is Nat Kellogg. I'm the Director of Manager Search, and I'll be covering hedge funds this quarter. Overall hedge fund returns were positive across almost all strategies during the month of December. And on a year-to-date basis, you can see consistently positive returns across all sub-strategies. Event-driven and equity hedge led the way. These strategies have some of the largest equity exposure and so track the broader equity markets, which had a very good year. While overall hedge fund performance was solid and consistently positive, it was considerably behind what was available in the long-only equity markets. Themes for the quarter, one of the most notable one was the poor performance for alpha on the long side. Long-short equity funds, particularly in the United States, suffered one of their worst months of long alpha since 2009. And while overall net exposure remains elevated, we did see gross exposure come down significantly towards the end of the year. This chart nicely displays that exposure across net and gross. The gold line there looks at net exposure, which you can see has been relatively steady throughout the course of 21 and was high relative to historical standards. Conversely, gross exposure came down materially towards the end of the year and is at the low end of historic ranges. Now, I mentioned earlier that long alpha was difficult to come by, and this chart nicely explains that in a little bit more detail. So in the purple bars, we show you the performance of the S&P 500 Total Return Index. And in the gray bar, we show you the Goldman Sachs VIP list, which is a combination of widely held hedge fund names on the long side. As you can see, during the first half of the year, those names slightly underperformed the broader market, but largely kept up. Conversely, in the second half of the year, there was significant underperformance on the long side, both in the third quarter, where the average stock on the long side owned by hedge funds significantly underperformed the market, and then in Q4, where it significantly lagged during an overall rally. This can somewhat be explained by the performance of the average stock. So what we show you here is the performance of the S&P 500 on a market-weighted basis, which is what we're all familiar with. And then the green bar is what we show you is an equal weighted basis. So this is just if you owned all 500 stocks in the S&P 500 on an equal basis, in them all the same amount in your portfolio. And again, here you can see significant underperformance in the second half of the year, where the average stock underperformed the market weighted index, both in Q3 and in Q4. This certainly made shorting a little bit easier, but overall made stock picking more challenging as the average stock underperformed the market. Turning our attention to 2022 and looking for areas of opportunities, SPACs are an area where hedge funds have been very active over the last couple of years, and we continue to think that there's significant opportunities for hedge funds in that space today. While the overall amount of issuance certainly slowed down, particularly in the second half of 2021, there are still over 800 companies listed and looking for targets across the marketplace, and that gives hedge fund managers significant opportunity to decipher which SPACs they want to back and which ones they want to avoid. We also think from a big picture perspective, hedge funds are relatively well positioned to handle a rising interest rate environment. What we show you here is the performance for a wide variety of asset classes during calendar years where interest rates increased, and that's defined by where the Federal Reserve was raising rates. As you can see, hedge funds' performance stacks up relatively well compared to other asset classes, particularly for long-short equity, which had a mixed year in 2021, but might do better in the year ahead, particularly if we get a rate increase cycle from the Federal Reserve. So just wrapping up and looking at risks and opportunities in the year ahead for hedge funds, 2021 proved challenging for alpha, particularly in the long-short equity space and particularly on the long side, but we think that the year ahead is likely to be a little bit more exciting. All of the IPOs and SPACs give hedge fund managers a lot more opportunities to look at, and the decline we saw at the end of last year of unprofitable companies may mean that fundamentals matter more in the year ahead. M&A activity continues to be very robust, providing lots of opportunities for merger arbitrage managers. And convertible bond issuance was very active in 2021 and likely will continue to be so in 2022, giving lots of opportunities for convertible bond managers. From a risk perspective, overall equity valuations are high and credit spreads remain tight, so generating overall rates of return on the long side might be a little bit more challenging in the year ahead. Short squeezes are certainly a risk, as we saw in 2021. This is much more on managers' minds in the year ahead, but certainly could pose a risk if we continue to see active participation by retail investors in the market. And last but not least, one of the themes we have seen over the last couple of years is hedge fund managers doing more and more private company deals. The last time we saw this level of activity from hedge funds in the private market was back in 2006 and 2007. Overall, most of those investments from that time frame ended up being largely disappointing, mostly because of the global financial crisis. So will history repeat itself, or will hedge funds do better on the private side in the years to come? 2022 may offer some insights into that.
Hi, I am Josh Cabrera, Marquette's Senior Research Analyst of Real Estate and Infrastructure. Core real estate performance illustrated a rebound from pandemic lows, lending credence to the overall recovery across property sectors. However, new COVID variants, supply chain disruptions, and inflationary concerns have put upward pressure on net operating income as the main driver of returns in the near term. Real estate allocations continue to compare attractively as traditional fixed income alternatives on a risk-return and inflation-adjusted basis. Given the ongoing fears of inflation, investors may wonder if real estate can be an effective hedge against both transitory and persistent inflation. This potential inflationary pressure will favor assets with shorter-term leases or built-in return escalators, such as multifamily and industrial. Transaction activity has improved significantly over the past 3 quarters and is expected to continue its momentum in the short term, especially in industrial, multifamily, and life sciences. Given the wall of available capital and cheap financing, many institutional investors should continue to increase their real estate allocations going forward. Apartments were able to capitalize on demand-supply imbalances, driving increased effective rent growth, tenant demand, and consistent leasing velocity. Strong multifamily demand is expected to maintain its torrid pace, benefiting from the recent job boom, current work-from-home dynamics, and surging home prices. Although the market for U.S. office space started to show signs of stabilization during the second half of 2021, a new wave of Omicron cases has already started to impede the recovery across most industries. As a result, the office sector could potentially endure the most profound impact from the recent case surge among the core property types. As institutional investors analyze the risks and opportunities for portfolio growth going forward, commercial real estate continues to recover in the current economic environment of low cap rates, cheap financing, and heightened levels of available dry powder. Despite the fact that the Omicron case surge and other systemic risks may delay the return to a post-COVID normal, industrial, multifamily, and select specialty sectors are primed for continued outperformance in the coming year. In addition, the trajectory of the Omicron case surge, inflationary concerns, and potential increases in cap rates may alter real estate valuations and allocations going forward. Finally, evolving remote working structures and lagging vaccination rates may further widen the gap between occupied and underutilized office space. Despite the fact that performance continues to be lagged on a quarterly basis, infrastructure is positioned well to continue its momentum in both private and public sectors against the backdrop of accelerating fundraising and transaction activity. Not only does infrastructure provide a defensive growth investment, but the risk-reward characteristics of the asset class can effectively be positioned as a liability management vehicle. Given the long-dated nature of its inflation-adjusted cash flows, infrastructure typically has a much longer duration than traditional fixed income, making it a more attractive exposure for hedging long-term liabilities. Due to investment-grade counterparties for many infrastructure holdings, the default risk has been historically low in comparison to traditional fixed income. Given the economic climate in the coming year, the implied default rate on infrastructure investments may not only be viewed as comparable to investment-grade fixed income, but can also be perceived as more advantageous from a returns perspective and as an adequate inflation hedge. As political discussions continue to surround the budget reconciliation bill, the infrastructure bill is expected to be a net positive for the overall economy, but also unlikely to materially change the opportunity set for private infrastructure investments, as opposed to the transformative impact to the public sectors. However, it does remain indicative for the ongoing need for investments into infrastructure, as well as the potential future stimulus for public-private partnerships. Looking ahead to go-forward risks and opportunities for infrastructure. Investors will continue to allocate to infrastructure assets as a vehicle to manage long-term liabilities, counterparty risk, duration, and inflation. Furthermore, the Biden infrastructure bill is expected to drive positive change for clean energy initiatives, non-traditional infrastructure, and digital assets. Finally, rising energy prices, the continued emergence of megafunds, and a higher interest rate environment may cause investors to gravitate away from infrastructure as a traditional fixed income alternative.
Hi, my name is Derek Schmidt, Marquette's Director of Private Equity, and I'll be walking through the market environment and our thoughts as we enter 2022. Private equity performance remains lagged, and these numbers represent performance through June 2021. But the private equity market continues to perform very well, exceeding public markets in 2021 and over the last year coming out of COVID. The North American venture capital market continues to be the best performing area of the market, as returns over the last year have increased 66%. This performance has aligned with the incredible demand for innovation and growth the space has experienced. Looking at return performance on a vintage year basis, we can see the median returns of recent vintages have been continuing to separate from their public market equivalents. As you can see in 2017 and 2018, the most recent years tracked, the outperformance is substantial, particularly at the upper end of the market. Private equity's consistent outperformance and significant return potential from funds in the upper half of the industry continues to fuel and justify the broad demand for the asset class. As we look ahead to 2022, we believe it is likely the private equity market continues to expand following a record year across the market from a fundraising and deployment perspective in 2021. This scale has required investors to make difficult decisions as many managers have come back to market faster and with larger funds. We think these trends continue in 2022, requiring continued guidance with program organization and discipline. The venture capital market has remained red hot as the best performing asset class. As this area of the market has expanded, more capital continues to move into supporting larger multi-billion-dollar growth companies, which is likely to remain consistent in 2022 as large pools of capital that have been raised await deployment. Venture performance and distributions in 2021 were supported by a very active IPO market. The pipeline of companies for 2022 to go public remains very strong, but will require continued acceptance from the public markets. 2022 is very likely to set another fundraising year across the private equity market, with many large buyout funds coming back to market and investors spreading their growth allocations across the buyout, growth equity, and venture capital funds. 2022 may be a year where private equity managers really reload the capital raised, as many funds are coming back to market following a year where more capital was deployed in the market than was raised. Managers at least enter 2022 with a cautionary view of deployment given the current market trends with elevated valuations, potential for growth deceleration, rising interest rates, labor and supply issues, and potential tax concerns. Looking within the U.S. private equity market, managers raised over $300 billion of capital in 2021. They did so raising fewer funds, but larger funds, with funds being raised at an accelerated pace, many less than 3 years from when they raised in the market last, as investors continue to have confidence in many of these proven and established managers. As mentioned, 2021 set a record in terms of U.S. private equity deployment, with the industry deploying over $1.2 trillion, a 79% increase in annual deployment following a slowdown in 2020 due to COVID. The market continues to see a great deal of this activity being in add-on acquisitions to platform deals. While the market continues to expand, it may prove difficult for 2022 to be as active a year for deployment. A rapidly growing portion of the U.S. private equity deployment has been within growth deals, with over $100 billion deployed in 2021. The growth equity space has been an emerging area within private equity, as minority capital has been increasingly utilized to accelerate growth and strategic acquisitions. Investors have been attracted to the unique investment characteristics that fit growth equity deals between buyout and venture capital opportunities. The U.S. venture capital market smashed previous records as market deployment doubled to over $330 billion in 2021. Activity was broad across the market, with over 15,500 deals being completed. But the late-stage deployment alone was the standout, eclipsing the previous record for the entire venture capital industry by itself by 15%. This asset class has truly evolved into an institutional asset class capable of deploying considerable amounts of capital to support innovation at private emerging growth companies. As the private equity market grows and raises and deploys more capital, we continue to see the pressures building across the market. Broadly, the opportunities remain attractive for investors looking to deploy more as they increase their absolute size of their private equity programs, and as there are a greater number of high-quality proven managers across the market, and the broadening investment landscape provides a greater dispersion of risk-return opportunities and shorter duration opportunities for consideration. The smaller end of the buyout and venture market remains fairly inefficient, providing attractive opportunities for smaller investments. With so much capital flowing into these larger funds focused on bigger companies, these earlier stage areas of the market continue to find lower valued entry points with the ability to grow and sell these companies into more competitive processes. While many of the private equity risks across the market remain the same, rising interest rates, supply chain issues, rising wages, remain pressures that could reduce deployment in 2022 as managers remain cautious and show investment discipline. The increasing amount of private equity capital and capital from non-traditional investors are driving up competition for quality assets. As more deals continue to occur, it is likely we see the net quality of companies invested in decline, which would pressure returns across the market. This is where investment experience, sourcing, and operational expertise are critical for private equity firms to maintain their market outperformance for investors. Finally, the late-stage venture market is one of the busiest and most expensive areas of the market. Even at significant scale, many of these businesses remain unprofitable and require more capital to fund continued growth. The public markets have been very accepting of these emerging opportunities, but for this area of the market to continue to do well, we will need to see acceptance and willingness to pay up for growth continue as businesses transition from private to public companies.
Hello, I'm Senior Research Analyst Brett Graffey, and I'll be going over the 2022 market preview for private credit. Reporting on a lag basis, private credit finished strong in the second quarter of 2021, exceeding the public fixed income and equity indices, except for the S&P 500. Alternatively, over the 1 and 3 year periods, private credit has lagged most public equity and fixed income indices, but over the 5 and 10 year time horizon, private credit has performed up to expectations, producing strong returns, exceeding public fixed income indices, but lagging the equity markets. Overall, the return and yield premium achieved by investing in private credit remains as a return driver and a risk mitigant for the asset class. As private credit continues to grow in popularity, investors recognize the benefits of adding the asset class to existing portfolios. An increasing number of investors are building out dedicated private credit sleeves inside their portfolios, while others are placing private credit allocations inside their private equity and fixed income portfolios. While private credit demand has grown significantly in the past decade, a recent survey of 71 global institutional investors by Probitas Research indicated that 40 to 50% of respondents were not actively investing in private credit, signifying how much untapped demand is potentially in the marketplace today. In 2021, inflation has emerged as a top threat to investor portfolios and a threat to the market overall. Private credit provides a viable option to help investors mitigate this risk within their broader portfolio. Private credit offers protections against inflation. Private credit returns are generated from interest rates that are based on a floating rate.
The floating rate nature of these loans means that if inflation causes short-term interest rates to rise, investors can be protected. Floating rate loans are highly likely to outperform fixed rate bond allocations in a rising rate environment. Overall, private credit performance was strong through the second quarter 2021 and has performed up to expectations over the past decade. Most importantly, the asset class continues to prove itself as a value add to institutional portfolios. The need for private credit remains strong as companies, both private equity backed and non-private equity backed, are in need of capital to finance new acquisitions or refinance existing debt at a lower cost, all against the backdrop of the lack of bank participation in the market. Being top of the capital structure and earning yield above traditional fixed income remains a key selling point for current and prospective investors. While these factors will continue to drive the asset class and attract new capital and new market entrants, we believe the fundamentals will remain intact and see many benefits for investors to include private credit alongside their existing fixed income and equity portfolios.
We'd like to wrap up by thanking you for watching this video today. And as always, we hope it has been a good use of your time, helped you and your communities prepare for what to expect out of markets in 2022, and how to position your portfolio most optimally given these conditions. For any clients who have questions, please feel free to ask your consultant for more information. More generally, you can send an email to 2 specific email addresses based upon your question. If you have specific research inquiries, please email research5@marquetteassociates.com. For broader Marquette inquiries, you can email marquettemarketing@marquetteassociates.com. And last, let me note that there are other materials available on our website which supplement this video you have just listened to. We have a 150-page market environment deck which contains the slides you've seen here, as well as a lot of other useful information and data, which backs up what you've heard today from each one of our analysts. And then we will also be publishing a market preview, a letter from our Director of Research, which is also available on our website. We thank you very much for spending time with us today and wish you all the best in 2022.